Hello and welcome back to Intelligent Investment Today. This is the podcast where we explore the timeless principles of value investing. The ideas that help investors navigate markets, not only in times of prosperity, but also through periods of uncertainty, volatility and change. And today we're going to take yet another slightly different path. Because while we usually draw from financial theory, market history, or the writings of great investors, today we're going to borrow an idea from a very different kind of book. A book about mindset, about priorities, about what we choose to care about, and perhaps more importantly, what we choose to ignore. Today we're exploring what we should call, for the sake of the podcast cleanliness rating, The Subtle Art of Not Giving a Flip by Mark Manson, and how its core ideas can be applied to value investing. Now, at first glance, this may seem like an unusual pairing. One, a self-help book, the other, an investment philosophy. But as we'll see, the connection is deeper than it first appears, because both are, in their own way, about discipline, about focus, and about making better decisions in environments filled with noise, emotion, and distraction. So, as always, sit back, tune in, and get ready to take on board another lesson in value investing, as inspired by Benjamin Graham. To begin, let's consider the central idea of the subtle art of not giving a flip. Despite the provocative title, the message is not about indifference. It is about selectivity, about choosing what truly matters and letting go of what doesn't. Mark Manson argues that we all have a limited number of things we can care about, and if we waste that attention on trivial concerns, we lose the ability to focus on what is genuinely important. Now, consider how this applies to investing. Markets are full of noise, daily price movements, breaking news, economic data releases, endless commentary. If you try to care about it all, you'll quickly become overwhelmed. And more importantly, you will become reactive. You'll start making decisions based on short-term information, rather than long-term value. This is where the connection to value investing becomes clear. Because value investing, at its core, requires a kind of selective indifference, a willingness to ignore the noise, to not give attention to every fluctuation, and instead to focus on fundamentals, intrinsic value, long-term earning power. And this is not easy. In fact, it runs directly against human instinct. We are wired to respond to new information, to react to changes, to seek control. But in investing, this instinct can be counterproductive, because not all information is equally important. And much of what we see day to day has little bearing on long-term outcomes. So one of the first lessons we can take from this book is simple. Not everything deserves your attention. Now, let's take this idea a step further. One of the key themes in the subtle art of not giving a flip is the importance of embracing discomfort, of accepting that meaningful pursuits often involve uncertainty, doubt, and temporary setbacks. And this is highly relevant to investing, because value investing is, by its nature, uncomfortable. You're often buying when others are selling, holding on when others are panicking, ignoring trends that appear obvious, and this can feel wrong. When a stock declines after you purchase it, it is quite natural to question your own decision, to doubt your analysis, to feel the urge to act. But value investing requires a different response. It requires the ability to sit with that discomfort, to reassess rationally, but not react emotionally. In other words, It requires you be comfortable not giving a reaction to short-term pain. This is not about ignoring risk. It is about distinguishing between signal and noise, between temporary volatility and permanent impairment of value. And that distinction is critical, because reacting to every decline can lead to poor decisions. Selling at the wrong time, locking in losses, missing long-term recovery. So again, the lesson is one of selectivity. Not every problem requires action. Not every discomfort requires a response. Another important idea from Mark Manson's book is the concept of responsibility. Taking ownership of your decisions. Accepting that outcomes, both good and bad, are part of the process. And this too maps directly into investing. Because in markets, it is very easy to externalise blame. To blame losses on the economy, the central bank, geopolitical events, or even the market itself. But value investing requires a different mindset. It requires personal accountability. If an investment does not perform as expected, the question is not who is to blame. It is, what did I miss? Was my analysis flawed? Did I overestimate something? This is not about self-criticism. It is about learning. Because over time, the ability to refine your judgment is one of the most important drivers of success. And that can only ever happen if you take responsibility for your decisions. Now, this does not mean every outcome is predictable. Markets are inherently uncertain. Even well-reasoned investments can produce disappointing results. But there is a difference between bad outcomes and bad decisions. And recognising that difference is key. Let's now consider another theme from the book. The idea of values. In The Subtle Art of Not Giving a Flip, there is a strong emphasis on choosing better values, focusing on things that are within your control, things that are constructive, that lead to meaningful outcomes. In investing, this translates into focusing on the right metrics, not short-term price movements, not market sentiment or popularity, but business quality, cash flows, balance sheet strength, and competitive advantage. These are the things that ultimately determine value, and yet they are often overshadowed by more visible but less meaningful indicators. So applying this idea means aligning your focus with what truly matters and being willing to ignore what does not. There is also an interesting connection when it comes to expectations. One of the arguments in Mark Manson's work is that unrealistic expectations lead to dissatisfaction. If you expect constant success, you will be disappointed. If you expect immediate results, you will become frustrated. And in investing, this is particularly relevant. Markets do not deliver consistent, predictable returns. There are periods of underperformance, volatility, uncertainty, and if your expectations are not aligned with this reality, you're more likely to make poor decisions. You may chase performance, abandon sound strategy, or take on excessive risk in pursuit of quick gains. Value investing, by contrast, requires patience and a long-term perspective, an acceptance that results may take a long time to materialise. And this is where mindset becomes critical, because the ability to stay disciplined often depends less on analysis and more on expectations. Perhaps one of the most powerful connections between this book and value investing lies in the idea of simplicity. Not in terms of business models, but in terms of decision making. The more variables you try to consider, the more complex your process becomes, and the more likely you are to become paralysed or inconsistent. Value investing, at its best, is relatively simple. Not easy, but simple. Assess the business, estimate its intrinsic value, compare that to price, act when there's a significant margin of safety, and then wait. This requires discipline, but also clarity. And clarity often comes from eliminating what does not matter, from focusing only on the essential. Which brings us back, once again, to the central idea. Not everything deserves your attention. As we begin to draw this discussion to a close, it's worth reflecting on the broader lesson here. Investing is often presented as a technical discipline, one that requires complex models, detailed analysis, and constant engagement. And while those elements can be important, they are not the whole story. Because at its core, investing is also psychological. It is about behaviour, about decision making under uncertainty, about managing emotion. And in that sense, the lessons from the subtle art of not giving a flip are highly relevant. They remind us to focus on what matters, to ignore what doesn't, to accept discomfort, to take responsibility, and to align our actions with long-term values. Because ultimately, success in investing is not about reacting to everything. It is about responding to the right things and having the discipline to ignore the rest. And on that, we draw this edition of Intelligent Investment Today to a close. I do hope you've enjoyed this slightly different exploration, bringing together ideas from Mark Manson's book and value investing, and seeing how mindset can shape investment outcomes. I'm David Coombs. This has been Intelligent Investment Today. Until next time, stay safe and happy investing.